Hello, this is Chapter 12, Corporations, Organizations, Stock, Transactions, and Dividends. So we're almost done with this half of the semester. So learning objective, describe the nature of the corporate form of organization, describe and illustrate the characteristics of stock, classes of stock, and entries for issuing stock. Describe and illustrate the accounting for cash dividends and stock dividends. Describe the effect of stock splits on stockholders' equity. Describe and illustrate the accounting for treasury stock transactions. Describe and illustrate the reporting of stockholders' equity. And describe and illustrate the use of earnings per share in evaluating a company's profitability. So characteristics of a corporation. A corporation is a legal entity, distinct and separate from the individuals who create and operate it. As a legal entity, a corporation may acquire, own, and dispose of property in its own name. It may also incur liabilities and enter into contracts. Most importantly, it can sell shares of ownership called stock. This characteristic gives corporations the ability to raise large amounts of capital. The stockholders or shareholders who own the stock own the corporation. They can buy and sell stock without affecting the corporation's operations or continued existence. Corporations whose shares of stock are traded in public markets are called public corporations. Corporations whose shares are not traded publicly are usually owned by a small group of investors and are called non-public or private corporations. Okay. So the stockholders of all corporations have limited liability. This means that creditors usually may not go beyond the assets of the corporation to satisfy their claims. Thus, the financial loss that a stakeholder may suffer is limited to the amount invested. The stockholders control a corporation by electing a board of directors. The board meets periodically to establish corporate policies. It also selects the chief executive officer, CEO, and other major officers to manage the corporation's day-to-day affairs. So here's the organizational structure, a graphic, stockholders, board of directors, officers, employees. So if you look at the big farm in Farmington, the stockholders are the Navajo Nation, actually each member of the Navajo Nation. Then the president's office selects a board of directors. There's 5 of them. And then the board of directors select the CEO and management. Then there's also the employees that are under the control of the officers. Characteristics of a corporation. As a separate entity, a corporation is subject to taxes. A corporation must pay federal income taxes on their income. Corporate income that is distributed to stockholders in the form of dividends has already been taxed. Stockholders must pay income tax on the dividends they receive. This double taxation of corporate earnings is a major disadvantage of the corporate form. But keep in mind you have limited liability. So here's some advantages and an explanation of those advantages. So go ahead and take a look at those. I'll read through the left side. Separate legal existence, continuous life, raising large amounts of capital, ownership rights are easily transferable, limited liability, like I said earlier. Disadvantages, you can read the explanation. Owner is separate from management, double taxation of dividends, and then regulatory costs. So forming a corporation, the first step in forming a corporation is to file an application of a corporation with the state. You can also do this with the Navajo Nation. State incorporation laws differ, and corporations often organized in those states with more favorable laws. For this reason, more than half of the largest companies are incorporated in Delaware. So here's some other examples of their companies where they've incorporated. So you can go ahead and take a look at it. This is also in your book. So notice most of them are in Delaware, but their headquarters are in different parts of the United States. So after the application of incorporation has been approved, the state grants a charter or articles of incorporation. The articles of incorporation formally create the corporation. The corporate management and board of directors then prepare a set of bylaws, which are the rules and procedures for conducting the corporation's affairs. So with Navajo Nation Enterprise, those are usually called your plan of operation. Costs may be incurred in organizing a corporation. These costs include the following: legal fees, taxes, state incorporation fees, license fees, promotional costs. Such costs are debited to an expense account entitled Organizational Expenses. So forming a corporation, so we're going to go organizational expense $8,500, cash $8,500, and this is paid costs of organizing the corporation. Paid in capital stock. Paid in capital from stock. The two main sources of a stockholder's equity are paid in capital or contributed capital and retained earnings. The main source of paid in capital is from issuing stock. The number of shares of stock that a corporation is authorized to issue is stated in its charter. The terms issued refers to the shares issued to the stockholders. A corporation may acquire or reacquire some of the stock that it has issued. The stock remaining in the hands of stockholders is then called outstanding stock. So authorized, issued, and outstanding stock. So here's a graphic of authorized, issued, and then outstanding. Number of shares authorized, issued, and outstanding. So this is kind of what it would look like. Shares of stock are often assigned a dollar amount called par value. Stock issued without par is called no par stock. In some states, the board of directors of a corporation is required to assign a stated value to no par stock. To protect creditors, some state laws require corporations to maintain a minimum amount of paid-in capital. This minimum amount, called legal capital, usually includes the par or stated value of the shares issued. The major rights that accompany ownership of a share of stock are as follows: the right to vote in matters concerning the corporation, the right to share in distributions of earning, the right to share in assets upon liquidation. So these stock rights normally vary with the class of stock. When only one class of stock is issued, it is called common stock. Each share of common stock has equal rights. When a corporation issues one or more classes of stock with various preference rights, such as a preference to dividends, such a stock is called preferred stock. The dividend rights of preferred stock are stated either as dollars per share, example, preferred $4 stock, $5 par, or as a percentage of par, example, preferred 8% stock, $50 par. Preferred stockholders have first rights preference to any dividends, thus they have a greater chance of receiving dividends than common stock. So preferred stock is higher, has greater value, or is more important than common stock. However, since dividends are normally based on earnings, the corporation cannot guarantee dividends even to preferred stockholders. So dividend preference, common stock, they usually line up after the preferred stockholders. So money available for dividends whenever there's a distribution. Types of stock. The payment of dividends is authorized by the corporation's board of directors. When authorized, the directors are said to have declared a dividend. Cumulative preferred stock has a right to receive regular dividends that were not declared, paid, or in prior years. Non-cumulative preferred stock does not have this right. Cumulative preferred stock dividends that have not been paid in prior years are said to be in arrears. Any preferred dividends are in arrears must be paid before any common stock dividends are paid, and any dividends in arrears are normally disclosed in notes to the financial statement. So these are little footnotes. To illustrate, so here's an example: 100,000 shares of cumulative preferred, $4 stock, $50 par, and 4,000 shares of common stock, $15 par. The corporation was organized in January 1 and paid no dividends. 11, 12, in 13, the corporation paid $2,200 in dividends, of which $12,000 was paid to preferred stockholders and $10,000 was paid to common stockholders, computed as shown in the next slide. So here's an example: total dividends paid $2,200, arrears $4,000 in 01 or 11, 12. 13, so it's shown right here, and then that equals the 12,000. So then the dividends available to common stock would be 10,000. So as a result, preferred stock received $12 per share in dividends, while common stockholders received $2.50 per share. In addition to dividend preference, preferred stock may be given preference to assets if the corporation goes out of business and is liquidated. However, claims of creditors must be satisfied first. So creditors always come first, and then the preferred stock, and then common stockholders. So issuing stock, a separate account is used for recording the amount of each class of stock issued to investors in a corporation. So here's an example. So cash was received of 101.5 million, preferred stock of 500,000, and common stock of 1 million. So issued preferred stock and common stock at par for cash. Stock is often issued by a corporation at a price other than its par. The price at which stock is sold depends on a variety of factors such as the following: the financial condition, earnings record, and dividend record of corporation, investor expectation of the corporation's potential earning power, general business and economic conditions and expectations. If the stock is issued, sold for the price that is more than its par, the stock has been sold at a premium. If the stock sold for a price that is less than the par, the stock has been sold at a discount. Corporations must keep track of its stockholders. Large public corporations normally use a financial institution such as a bank for this purpose. The financial institution is referred to as a transfer agent or a registrar. So when stock is issued, here's premium. When stock is issued at a premium, cash is debited for the amount received. Common stock or preferred stock is credited for the par amount. An account entitled paid in capital in excess of par is credited for the excess of amount paid over par. So here's what it looks like. Cash 110, preferred stock 110, paid in excess of par will be 10,000. So when stock is issued in exchange for assets other than cash, such as lands, buildings, and equipment, the asset acquired at record recorded at the fair market value. If the value cannot be determined, the fair market value of the stock issued is used. So here's an example. So land of 120,000, common stock 10,000, and then paid in capital excess of par is 20,000. Okay, no stock par. When no stock par is issued, cash is debited and common stock is credited for the proceeds. As no par stock is issued over time, this entity is the same even if the issuing price varies. So here's an example. Cash of 400,000, common stock 400,000. So issued 10,000 shares of no par common stock at $40. So cash is credited for 36, common stock 36,000, and then issued no par common stock at $36. Okay. In some states, no par stock may be assigned at a stated value per share. The stated value is recorded. Like a par value, any excess of the proceeds over the stated value is credited, paid in capital in excess of stated value. So that would be what we would credit. So here's an example. Cash 400,000, common stock 250, paid in excess of stated value 150,000, so that equals 400 still. Cash of 36, common stock 25, paid in excess of stated value 11,000. Still adds up to 36,000 though. Okay, so here's the checkup corner. I'll let you go ahead and do this one on your own. Go ahead and take a look at this. Is also in the book. So here's the how you would calculate this. This will probably help you with your homework as well. So accounting for dividends, I'm going to stop this video right now and I'll finish this with video 2.